So now we are going to look at liquidity ratios. Liquidity ratios are meant to answer if the business will be able to meet their cash obligations as and when they come due. So the first one is current ratio. Current ratio is current assets over current liabilities, as you can see here. Current assets divided by current liabilities. And current ratio tells that the immediate liquidation of Riverside current assets will provide $2.3 of cash for every $1 of current liabilities. So every $1 of current liabilities produces $2.3 of cash. Days cash on hand is a true measure of business liquidity, and it can tell us whether the business can meet its payments as they come due. It is more related to cash inflows and outflows rather than assets and liabilities. So we have cash and short-term investments in the numerator, and in the denominator we have cash expenses divided by 365, which is the 1 year, number of days in the year. So that gives us 22.5 days. So 22.5 days is the amount of days that they have cash on hand. This business, Riverside, has cash on hand for 22.5 days. So current ratio, as you can see, for 2020 is 2.3 times, and 2019 is 1.7 times. The days cash on hand is 22.5 and days, and for 2019 is 18.9 days. So the peer average is 2 for current ratio, 2 times, and days cash on hand is 30.6 days. So you can see the days cash on hand that Riverside has is less than the median, is less than the industry average. It's lower than the average. Its a liquidity position is worse than average, and that is measured by the days cash on hand. So that if the number of days is less than the peer group average, it means that Riverside has a less or a worse liquidity position as compared to its peers. The two measures of liquidity, the current ratio and days cash on hand, can have conflicting results, and it is here in this case that they have a little bit of conflicting results. Perhaps because the average hospital has a greater proportion of cash and equivalents and short term investments in its coded assets mix than Riverside. Maybe Riverside needs an extra need of cash in 2019 and 2020. So that is why these numbers are showing a little bit conflicting. So the important thing to note is that the best measure of liquidity is the cash budget. So how much cash do you actually have? How much money do you have in terms of cash and cash equivalents that are more near to cash, that can be liquidated much easily? Debt management ratios are debt ratio and times interest earned. By raising funds through debt, owners of for-profit maintain control with limited investment. For not-for-profit, debt allows more services to be provided than if the organization were financing only with earnings. There is a little bit of difference when it comes to for-profit and not-for-profit. If when it comes to not-for-profit hospitals and they take debt, it allows them to provide more services. If they were financing just by themselves and with their own earnings, they may not be able to provide that many services. Debt management ratios are a group of ratios that measure the extent of a business's financial leverage, their capital structure. So there's two categories: capitalization ratio, which uses balance sheet data and determines the extent to which fixed financial charges are covered by reported profits. Coverage ratio uses income statement data, and that determines the extent to which fixed financial charges are covered by reported profits. And then we have the debt ratio, which measures the percentage of total capital provided by creditors. So Riverside debt ratio is 29%, meaning its creditors have supplied less than one third of the business's total financing. In other words, each dollar of assets was financed with 29 cents of debt and 71 cents of equity, like we saw the last time. Times interest on ratio is measured by dividing earnings before interest and taxes by interest charges. So, interest expenses. So, earnings before interest and taxes divided by interest expenses gives you the times interest earned ratio, and that measures the number of dollars of accounting income that is available to pay each dollar of interest expense. How much of accounting income do you have available to pay each dollar of interest expense? That is the times interest earned, and that shows the extent to which income can decline before it is less than annual interest cost. In the case of Riverside, it is $10,114. So that is the extent to which income can decline before it is less than annual interest cost. Debt management ratio is the next one, and that is debt ratio. Riverside uses less debt than the average hospital. As you can see, the comparison is given here. It is a capitalization ratio, while the times interest on ratio is a coverage ratio. There are many variations of these ratios. Now, the times interest earned is 6.6 times for Riverside, and that is more than the peer group average, which is 4 times. Um, so the Riverside interest is covered 6.6 times, so it has $6.6 of accounting income to pay each dollar of interest expense. Uh, like we already said, the peer group average is 4 times. So the hospital is covering its interest charges by a relatively high margin of safety. Asset management ratios show FA turnover, fixed assets turnover. It measures how effectively a business assets are being utilized. How effectively are you using your land, your building, your equipment? These ratios help answer whether the amount of each type of asset reported on the balance sheet seems reasonable, whether it is too high or whether it is too low in view of current operating levels. So the fixed assets turnover measures the utilization of property and equipment, and it's the way it is calculated is total revenue divided by net fixed assets, and net fixed assets include net property, plant, and equipment. So that is 0.95 times, which means that each dollar of fixed assets generated 0.95 in total revenue. And turnover, uh, uh, total assets turnover measures the turnover or utilization of all of the business assets, not just fixed assets. For Riverside, each dollar of total assets generates 75 cents in total revenue. So Riverside total assets turnover is below the average, but not as far as it is as compared to the fixed assets turnover ratio here. So the fixed assets turnover ratio is below the total assets turnover ratio is below the average, but the fixed assets turnover ratio is much below the industry group average. And as you can see, how far are utilizing your business assets is what the asset management ratio tells us. So maybe Riverside is not utilizing its fixed assets as much. Maybe there are some empty rooms, there is some empty clinics that are not being utilized to their full capacity. So the next one here on this slide, as you can see, is the days in patients accounts receivable, the DIPAR, which is measured by net patient accounts receivable divided by net patients receipt services revenue, how much you receive from the patients, divided by 365, which is 1 year. So how much you have yet to receive is the numerator, divided by how much you have already received, and that is divided by the number of days. So that gives you 77.3 days in case of Riverside, and that 77.3 days actually, on this slide it's written wrongly. It should be 77.3 days here. It's written 73.4, but in any case, it is more than the industry average. So this means that Riverside is not doing well as the average hospital is in collecting its receivable. You want less number of days in case of um, accounts receivable, days in accounts receivable. You want to be able to collect your revenues faster. Okay, so the number fixed asset turnover ratio 0.95 is telling us that Riverside is not using its fixed assets as productively as the average hospital. And the total assets turnover ratio measures the turnover or utilization of all business assets, not just fixed assets. So for Riverside, each dollar of total assets generated 75 cents in total revenues. Riverside total assets turnover is below the average, but it is not as low as the fixed assets turnover ratio. Managers of DuPont company developed the DuPont analysis, and that is why it's called the DuPont analysis. It helps in understanding the relationships among several ratios, and it is based on the fact that return on equity can be expressed as a product of three ratios: profit margin, total assets turnover, and equity multiplier. So total margin is basically talking about expense control. How much can you control your expenses and become profitable? Total asset turnover is how much are you utilizing your assets. Are there any rooms or buildings or equipments that they are just lying there and not being utilized? And equity multiplier is talking about debt utilization. How much debt are you utilizing? So total margin multiplied by total assets turnover multiplied by equity multiplier gives you the return on equity. And so the way you calculate total margin is net income divided by revenue, as we've already seen. Total asset turnover, we've also seen, is revenue divided by total assets, and debt utilization is total assets divided by total equity, and all of this gives us the return on equity. As you can see, the total assets and total assets will get cancelled here. The revenue and the revenue will also get cancelled here, so we will be left with net income divided by total equity. So in 2020, we have this number as 8%. In 2019, we have this number as 2.4%, and in the industry average is 8.4%. So this equation can also be written as return on equity equals return on assets multiplied by equity multiplier, because some of these terms are getting cancelled. So the Riverside total margin was 7.5%. So the hospital made 7.5 cents profit on each dollar of total revenue. Also, assets were turned 0.75 times during the year, so the hospital earned a return of 7.5% multiplied by 0.75 is equal to 5.6% on its assets. Compared to average, Riverside has high profit margin, so they have a better control over their expenses, below peer average in asset utilization though. And they also have a lower use of debt financing. Overall, the results show that Riverside gets a little less return on equity capital than the average hospital in the industry. In addition to ratio and DuPont analysis, there are two other types of analysis: the common size analysis. All income statement items and balance sheet accounts are expressed as percentages of revenue or total assets, which facilitates comparisons when there are scale differences. In percentage change analysis, year to year changes in income statement items and balance sheet accounts are expressed as percentage changes, which helps identify items that are out of control. The operating indicator analysis involves the use of operating data, and that is opposed to financial statement data, and that helps in explaining a business's financial condition. Um, Remember, there were two types. One was the financial analysis, financial condition analysis, which tells us how to assess or evaluate a business's financial condition. And the second one over here, as you can see, is for managers to understand the underlying operating conditions, and it is based only on operating data, which means what you do with patient services, and that helps in explaining the business's financial condition better. And the managers will be able to better deal with financial problem areas.